Welcome back to the channel. In today's episode, we are discussing UiPath and their latest earnings report. During regular trading hours, the stock was up about 7%, but in after-hours trading, it dropped roughly 4%. Something unusual also happened during the conference call. About halfway through, it seemed like the call suddenly crashed. At this point, it's unclear whether it will come back or what exactly happened, but I don't think we necessarily need to wait for the full conference call to continue our discussion. If the call does resume and any major headlines appear, those can always be shared later. Even without the rest of the call, we already have enough fresh information to analyze the stock, the earnings numbers, and what the bull case and bear case could look like for UiPath going forward. Before diving deeper into the numbers, it's worth mentioning that despite the 4% after-hours decline, this was actually an earnings report that increased my confidence in the company's overall story and growth trajectory over the next few years. This content is for educational and informational purposes only and should not be considered financial or investment advice. The information discussed about UiPath or any other company is based on publicly available data and personal analysis, and it may not be completely accurate or up to date. Investing in stocks and financial markets involves risk, including the potential loss of capital. You should always conduct your own research and consult with a qualified financial advisor before making any investment decisions. The creator of this content is not responsible for any financial losses or decisions made based on the information provided. Now let's start with the numbers for the fourth quarter. Revenue came in at $481 million, beating the estimate of $465 million, which is a very strong top-line result. Earnings per share were 30 cents compared to an estimate of 25 cents, another clear beat. The net retention rate was 107%, which essentially means that even if UiPath did not add a single new customer, its revenue would still grow about 7% year over year because existing customers are spending more on average. That is a good number, though not necessarily exceptional. A low retention number would be around 98% or 99%, while a mid-tier number is usually between 105 and 110%. Once you start seeing numbers above 110% or 150%, it typically indicates companies are upselling their existing customers very effectively. UiPath also reported ARR, annual recurring revenue, of $1.85 billion, which is up 11% year over year, with net new ARR of $70 million. The company also issued full-year guidance. UiPath uses a fiscal calendar where the year can sometimes sound confusing, but effectively they are guiding for revenue between $1.76 billion compared to the estimate of $1.74 billion, meaning it was a beat and raise across the board. In addition, the company announced a new $500 million share repurchase authorization after already completing a $1 billion stock buyback program, meaning they have already bought back more than $1 billion worth of their own shares and are now continuing with another repurchase plan. Looking deeper at the reported metrics, revenue increased 14% year over year, while ARR reached $1.853 billion, up 11% year over year. The company reported GAAP operating income of $80 million, non-GAAP operating income of $150 million. They also announced the new $500 million stock repurchase authorization following completion of the earlier $1 billion buyback program. In the official statement, Daniel Dines, the founder and CEO of UiPath, said that the company delivered a strong quarter and completed a year of disciplined execution, with ARR growing 11% year over year to $1.853 billion. He explained that as enterprise AI adoption moves from experimentation to large-scale deployment, customers increasingly need a platform capable of executing complex processes with reliability, governance, and scale. By combining deterministic automation, agentic AI, and enterprise-grade orchestration on a single platform, UiPath aims to provide the execution layer that enterprises rely on to run mission-critical processes in what they describe as the agentic era. Additional financial metrics from the quarter include a non-GAAP gross margin of 86%, GAAP operating income of $80 million, and non-GAAP operating income of $150 million. Net cash flow from operations came in at $182 million, which is a very strong number. Adjusted free cash flow on a non-GAAP basis was also $182 million. As of January 31st, 2026, the company held $1.69 billion in cash, cash equivalents, and marketable securities. For the full previous year, revenue increased about 13% year over year, with $186 million in additional ARR, and total net cash flow from operations for the year reached $371 million. Considering that $182 million of that came from just the most recent quarter, cash flow and profitability could become an increasingly important part of the story for UiPath going forward, especially as we move into 2027. For the first quarter of fiscal 2026, the company expects revenue to fall between $395 million and $400 million, with ARR projected in the range of $1.894 billion to $1.899 billion as of April 30th, 2026. They are also expecting non-GAAP operating income of about $80 million. For the full year 2026, revenue guidance is between $1.754 billion and $1.759 billion. And the company expects ARR to reach between $2.51 billion and $2.56 billion by January 31st, 2027. Non-GAAP operating income for the full year is expected to be approximately $415 million. The only reason this earnings report might receive something like a B+ or A- instead of an A+ is the ARR target for 2027. With ARR currently around $1.853 billion, this guidance implies roughly 11% ARR growth. However, UiPath has a history of under-promising and over-delivering, which is something most companies try to do, and this guidance appears fairly conservative. I personally expected to hear an ARR projection closer to $2.2 billion or even $2.3 billion, but deploying AI agents across enterprise environments does not happen overnight. There are usually multi-month pilot programs and testing phases before large-scale deployment occurs. Unfortunately, because the conference call appeared to crash, we did not hear much discussion about Mastro, which is another initiative the company has talked about previously. UiPath has said in the past that 2027 could be the major growth year for Mastro, and that remains where the story currently stands. It is possible that some of that growth could begin to materialize later this year, but the company did not include it aggressively in their guidance, which again suggests they are taking a conservative approach. When the earnings numbers were first released, the stock initially moved higher, so the after-hours decline does not appear to be directly tied to the financial results themselves. There may simply be a digestion period as the market processes the data. We saw something similar with Zeta Global, where the stock rallied into earnings but then became volatile afterward. Overall, UiPath still appears to be a stock trading at a relatively low valuation, and in many ways it seems like the market has largely counted it out. Yet the company delivered some very solid numbers in this report. The only area of concern is the ARR guidance for next year. Either the company is being intentionally conservative so it can beat expectations later, which is often the case, or it genuinely does not expect Mastro to significantly impact the business until 2027. My personal view is that management is simply setting a conservative ARR target so they can comfortably exceed it later. The last thing a company wants is to miss expectations after setting overly aggressive guidance. It is also important to remember that the stock is not currently priced for outstanding performance. It is priced as if the company might deliver weak results. These numbers, however, were far from weak. For investors who are bearish and expecting the stock to perform poorly in the coming weeks, there is a strong argument against that view. The company might also be motivated to keep expectations modest while the stock price remains relatively low, allowing them to repurchase shares more aggressively before the price potentially rises above $20 per share. Stock buybacks generally help increase earnings per share and reward shareholders by increasing the value of their equity. That could also explain part of the conservative ARR guidance for this year. Overall, this earnings report reinforces the idea that UiPath's business remains healthy. The company is performing well, and artificial intelligence does not appear to be a major threat to its core business model. In fact, during the conference call, the management team began discussing how AI could actually help accelerate the company's growth. Ultimately, the company set full-year guidance around $2.05 billion in ARR, while some expectations had been closer to $2.2 billion or $2.3 billion. It would not be surprising if next quarter they raise that guidance to around $2.1 billion, then to $2.15 billion, and eventually to $2.2 billion by the end of the year. In other words, the company might still reach similar numbers, but choose to gradually increase its forecasts each quarter. Analysts will also begin publishing updated price targets tomorrow morning, which could introduce additional volatility in the stock. Currently, short interest remains high at about 25%, though some short sellers appeared to cover their positions toward the end of today's trading session. With numbers like these and a relatively low valuation, it would not be surprising if more short sellers begin covering their positions. This does not look like an obvious short candidate given the current fundamentals. Because of that, tomorrow could potentially turn into a strong green day for the stock. Let me know your thoughts about UiPath and these earnings results in the comment section below. Don't forget to hit the like button and subscribe to the channel if you haven't already.